to all. Kelvin here again. Welcome back to today's Daily Dose of Market Insights. Today will be Thursday, the 18th of September 2025. Very good morning to all. And today will be Expo's FOMC Day, which has a very interesting impact on the global broad-based cross-asset classes. So before we jump that into greater detail into which is our cover in today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, any forecast, prediction or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. So as usual, before we jump straight into those intraday technical outlook, let's have a recap what has taken shape yesterday and as well as in today's early Asia session in terms of news flow, relevant economic data releases, and their impact on the broad-based cross-asset classes. All right, so yesterday key risk event is the FOMC meeting over here. So what the Fed did was within market expectation on one part of it. So the first part of it was that they cut rates as expected by 25 basis point. So what's interesting, let me share with you some of the tidbits that I'd like to actually highlight to you guys that could have an impact on the broad-based cross-asset classes. So let us start with the key takeaways first on the after yesterday's FOMC meeting, and also taking into account of Fed chair press conference over here. So the Fed cut rates by expectation by a quarter point, and the key thing is it leaves the door open for more. So based on the statement they released over here is that yes, they cut 25 basis points. It's not cut and pause and they wait and see. So there could be a high chance that the Fed will actually do more over here. And what's interesting over here is that why they actually mentioned that, because they say that the downside risk to employment has risen. So they actually not right now acknowledge that the US labor market is deteriorating. So with this labor market deterioration, it outweighs the risk of a potential sticky inflation scenario in the US economy, which is actually more driven by the ongoing current White House tariff policy. And more interesting over here is that most recently we have a Federal Reserve governor, which is kind of handpicked by US President Trump to be part of the board of governors, who is also formed part of the voting committee, which is this guy called Miran. So Miran previously was the White House so-called chief economic advisor. So he was being so-called indirectly tasked by US President Trump to actually sway the decision-making process of the Fed in favor of the White House. So we know that President Trump has been very, very critically against Fed chair monetary policy stance of erring to the cautious side of things rather than embarking in a very aggressive rate cuts. So this guy over here dissent and voted half-point cut, but he's the only guy that dissent for a half-point cut. The rest of the other Federal Reserve officials that has been more dovish than Fed chair in the last 4 to 5 meetings move in line in the general consensus of having a 25 basis point cut. So those are, one of them will be Weller, which is also a very dovish official, but he did not actually vote for a 50 basis point cut. So all in all, it seems that despite US President Trump jawboning of the Fed to be much more dovish than what their leader is advocating, which is Fed chair right now, most of the Federal Reserve officials actually has a consensus view that they are likely doing things much more independent rather than being swayed by the current White House preference of having more aggressive interest rate cuts over here. So at the start, once this has been released before Fed chair press conference, the yield dropped, the US Treasury yield dropped, the dollar also fell and touches a 2025 low. Let's share with you the chart of the dollar index. And what's interesting over here is that as the press conference move on, we start to see the dollar bouncing back up. Okay, so what do I mean by that? So if you look at the chart of the 5-day rolling performance chart of the US dollar against other major currency, so this was the drop over here, pop, okay, right at 2 a.m. Singapore time, all right, where the FOMC statement decision released and the dot plot they released. Then while Fed Chair underwent his press conference, which kickstart at 2:30 a.m. Singapore time over here. Okay, look at my cursor. So this where after he spoke, the dollar rebounded. Right, actually the dollar rebounded. So why the dollar rebounded or the dollar has that intraday spike up is because he mentioned about this thing called, this meeting is something like a risk management cut over here. So what do I mean by that? So let me go back to just now that that Bloomberg we call it a summary. So let me share you guys over here. Oops. Risk management. All right. So let me go down. Right. So Powell said this could be viewed as a risk management cut. So what does it mean? So risk management cut, this suggests that he's not necessarily wedded to this being part of a new cycle of easing. That means by this emphasizing this one called risk management cut, he implied that yes, this time round I cut 25 basis point. The next meeting could be by meeting by meeting basis, depending on fresh new data that comes into the US economy. Then they will decide whether to advocate another interest rate cut or not. So this is what being implied by him. So that actually causes the dollar to actually spike up after he mentioned this particular we call it a verb, call it a risk management cut. But what's interesting over here is that if you were to look at the dot plot right now, so let us shift to the dot plot. So what is the dot plot? So dot plot is a summary of economic projection where the US Federal Reserve officials do their own projection, and they will release a median forecast of where they expect key US economic variables will be this year, next year, and 2 years later, which is 2027. And most importantly, they also have an implied suggestion whether they are dovish or hawkish by doing a projection of where the Fed funds rate will be as well. So this dot plot is not released every FOMC meeting. It only released after the third meeting of the released every quarter. I'll put it every quarter. So now this time around they released yesterday. So next month, October, they will not release it. So the next dot plot will be released on December. Right, so view it as it's a kind of a quarterly basis. So yesterday, the release of the dot plot, let me share with you guys. All right, so this is the dot plot. So let me very quickly go down to the projected appropriate policy path. So this is the most important within the dot plot, because this is where they pencil in their projection, a median projection over here. So June projection, it was at 3.9%. So they expect the Fed funds rate to end at 3.9% by 2025. So this time around, they actually introduced another cut of roughly, because you look at 3.6 minus 3.9 is 30 basis points. So that's implied another additional interest rate cut for 2025. So this will bring down the Fed funds rate to 3.6%. That's within what market is expecting. All right. So market is expecting also 3 interest rate cut before FOMC meeting yesterday. So those who followed my daily dose, I've been stressing that so-called 3 interest rate cut that's been penciled in by the Fed funds future traders causes the dollar to be weak in the last 2 weeks. All right, so that's actually moved in line with what market is expecting, and also they lowered the Fed funds rate in 2026 and 2027 by also 20 basis point for the as compared to the previous projection in June. So for 2026, previously they penciled in at 3.6. So what it means that previously June projected by the end of 2026 it will be at 3.6, and right now potentially it will be lowered by 3.4%. So that is a 25 basis point cut reduction. So if you look at 3.6 end of the year of 2025 and 2026 at 3.4%. So that's implied around 25 basis point cut. So another quarter point cut next year only. And if you look at in 2027, previously it was at 3.4%. So in the June projection, yesterday they project it to be lesser at 3.1. But if you compare it from 3.4 to 3.1 from 2026 to end of 2027, they only pencil in 25 basis point cut. So what it implies over here is that the Fed itself is the Federal Reserve officials median projection, means median taking into account of the median, is they are not advocating an aggressive interest rate cut cycle based on the dot plot. So what you could see over here is that they only pencil in so far an implied 25 basis point cut for 2026 as a whole, and 2027 25 basis point cut. And why they actually has such thinking is because if you look at their new projection for GDP growth, they actually upgraded their GDP growth slightly in 2026, all right, and also in 2025. So for the June projection, previously they penciled in 1.4% annual growth for US GDP growth, but this time around they upgrade it by 2 basis points for 2025 to be at 1.6, and they also upgrade it by 2 basis points from 1.6 projected in June for 2026 annual GDP growth to be at 1.8, and also slightly upgrade the 2027 projection as well from 1.8 to 1.9. So there is actually a slight upgrade of GDP growth. So that actually explains why the Federal Reserve officials as a whole, their median projection for the Fed funds rate doesn't imply an aggressive interest rate cut yet. So that also gel in line with just now I shared with you the Fed chair mentioned about that risk management cut. So they are so implying they are giving these guardians that they are taking things step by step at a time rather than indicating that right now is the start of an aggressive interest rate cut cycle. That means meaning that every month there will be a potential 25 basis point cut. So that is not what they are trying to guide the market. All right, and also if you look at the employment rate as well, so employment rate for this year they maintain at 4.5% projected at the same projection in June. All right, but they kind of upgrade the unemployment rate to a better figure from 4.5 previously projected in June for 2026 to 4.4, and also similar for the June projection of 4.4 for 2027, they upgraded it to 4.3. So they actually mentioned there could be a slight labor market improvement in 2026 and 2027 based on their latest projection as compared to the previous June projection. And you look for core PCE inflation. Okay, so now this is the inflation trend in the US. So inflation trend in the US, they actually upgraded the inflation trend for next year. So for 2026, previously it was penciled in at 2.4% in the June projection, and now they push it up to 2 basis points to 2.6%, and keep it the same at 2.1% for the 2027 annual projection for core PCE inflation, the same that was being projected in June. So based on the latest projection for core PCE trend, they actually implied that they are still concerned about this inflation remains rather sticky for next year for core PCE inflation to still inch up higher to 2.6%. So that's actually way above their long-term target. And this time around, they still expect by 2028, the core PCE should be at 2%. All right. So right now, they're actually weighing, there's still some officials that are still weighing the risk about sticky inflation over the potential labor market softness that could actually be still lingering in the market. All right. So with that, bearing in mind with that, what you see over here is that we start to see the dollar bounce. All right. So if you look at the dollar index over here, so the dollar index yesterday, it hit an intraday low of 96.21 over here, but by the end of the US session, it means after the conclusion of Fed chair press conference, it inched out a gain of 0.37%. And what's interesting over here in today Asia session, it's rather minute one, so there is no follow through of that US session gains for the US dollar. It's rather almost trading unchanged, as it's now heading close towards this former 97.3 key support now turns into a pullback resistance. So why is this pullback resistance so important? If we go to the monthly chart of the US dollar index over here, okay, so this 97.3, right, is exactly this line here, and this is the lower boundary of this long-term circular ascending channel support, or I would say that lower boundary is the support. The support of this long-term ascending channel that has been in place that kept previous significant decline in the dollar since May 2021. Previously, it survived in May 2021. It managed to survive in the month of July, and as well in the month of August this year. So on a daily basis, it actually closed down below 97.3 in the last 2 days. All right, in the last 2 days means on Tuesday and as well as yesterday's FOMC meeting and ex-post Fed chair press conference. And right now it attempt to retest this level again. So if we could have a weekly close, because tomorrow is Friday, so we have one more day to go, a weekly close below 97.3, it would increase the odds that we are now on the brink of a still major bearish downtrend move of the US dollar, despite the fact that the Fed is not guiding us a aggressive interest rate cut cycle yet, just purely based on the price action of this chart itself. And also, this just now I show you that is a monthly chart, right? So it will be good that if we could have a monthly close below 97.3 as well, and it's not too long, it's just about 1.5 weeks from now. If you also have a monthly close below 97.3, it could potentially cement that start of a multi-month or major downtrend move in the US dollar. All right, so that's for the US dollar. And what's interesting over here is that in the US stock market is rather healthy after yesterday. The bulls are still intact. Why? Because despite the fact that earlier on there was a rally on the S&P 500, still recall that yesterday I shared my daily dose that do look out for a risk of a pullback on the S&P and the Nasdaq 100. So both the S&P and the Nasdaq 100 pull back as expected and hit right exactly at the pivotal support that I'll share you guys before shaping that minor bullish intraday reversal yesterday after the Fed chair press conference. So there's a minor V-shaped recovery on the S&P and the Nasdaq 100 as well. And what's interesting over here is this, okay, let me go back again, is the outperformance of the Dow Jones and the Russell 2000. Okay, still recall that yesterday I mentioned that the Dow Jones is very interesting because it's resting at a key short-term range, former range resistance now turns into a pullback support, and indeed it actually rallied yesterday, all right, and managed to outperform the S&P 500 and the Nasdaq 100 by the close of the US session. So it's up by 0.57%, followed by the Russell 2000, is also up by 0.18%. So the reason why the Dow Jones managed to kind of outperform yesterday was because of the re-steepening of the US Treasury yield curve. So what do I mean by that? So if you look at this chart, right, very quickly, okay, so this chart I plotted, all right. So I think I shared this chart with you guys before because now let me share again. So this chart over the top chart here is the Dow Jones Industrial Average. So we know that the Dow Jones Industrial Average has been underperforming the S&P and the Nasdaq 100 since the start of this year, and also since this particular January, April ex-post US Liberation Day, which is that global tariff policy that's been announced by the US White House. It plunges down. Then it did a slow recovery, but during this slow recovery, it did manage to actually clear the fresh all-time high previously that was being hit on 4th of December 2024. So this was the rally ex-post US presidential election. So what you could see over here is that they only did a fresh all-time high on 22nd of August, right? So this 22nd of August fresh all-time high, let me share with you guys. I'll put it up here. Oops. Okay, yeah, this one. So if you could put it over here, right, this fresh all-time high has been met in line with this purple line that is sloping upwards, right? So this purple line that is sloping upwards is the yield curve. So basically, what is this yield curve? This yield curve is actually looking at the US Treasury longer term yield minus shorter term yield. So take it as a spread. The 10-year US Treasury spread minus the 2-year Treasury spread. That means, i.e., the 10-year is actually more than the 2-year. Okay, so that's why this line is sloping upwards, is turning upwards. And once this line is sloping upwards, this upward sloping line, if it keeps on going up higher and higher, it would benefit the financial sector, especially financials company that has wholesale banking. So what do I mean by that? So we know banking business, right? There's this where they actually borrow in the short term, and with this borrow in short term funds, they lend up longer term. All right. So this is what I call the net interest margin of banks. So if this slope, right, the 10-year minus 2-year US Treasury spread is sloping upwards, I call it steepening, that would increase or improve the net interest margin for banks. And we know that the Dow Jones Industrial Average, the financial sector constitute to 27% weightage in the Dow Jones Industrial Average. So that actually explained to us why the Dow Jones managed to shape that bullish breakout above the December 2024 current previous all-time high on the 22nd of August. And we also explained to us why, okay, let me push it down, that after that, the treasury yield curve actually sloped downwards. So this sloping downwards over here caused a very minor choppy movement on the Dow Jones Industrial Average. All right, so they can't actually break fresh all-time high after this line is sloping downwards over here in the last 1 or 2 weeks or so, where the S&P 500 and the Nasdaq 100 begin to inch up higher. And what's interesting over here is that prior to yesterday's FOMC meeting, there was actually a slight bounce starting on last Thursday at this 0.48%, and it starts to actually bounce up higher towards even before FOMC meeting yesterday was at 53. Prior to the meeting, it was at 52. So from 52 to 48, there's actually a rebound. And where it rebound off from a major ascending trend line previously that kept the previous pullback from July, from 17th of July to 16th of July. So yesterday, right after the FOMC meeting, it actually right now indicate that the steepening of the 10-year minus 2-year US Treasury yield curve is on a path of a major uptrend again. That actually supports the potential further improvement of the net interest margin of US financials company, especially those that has wholesale banking. And like I mentioned, the US financial sector constitute of 27% weightage in the Dow Jones Industrial Average. So that led to a positive feedback loop into the Dow Jones Industrial Average, which is our US Wall Street 30 that bounced up right exactly at my pivotal support that I highlighted yesterday. All right, so later I'll share with you on that chart over here. So given the fact that the US dollar yesterday do a very choppy price movement, actually came back, it bounced back up again. So that actually causes a bit of negative feedback loop into the gold price over here. So gold price yesterday declined by negative 0.8%. So later I'll share with you what are the key levels and the trend bias to watch for gold on the intraday basis. All right. Now, before we jump straight into the intraday technical look, there's one more particular news data that I'll share with you guys that has been released early today's Asia session. Is more pertaining to the Australia economy over here. So for the Australia economy, at 9:30 a.m., the employment change was released. So the employment change actually came in way below market expecting. So market was expecting 22K jobs added for the month of August, below 26.5K added for the month of July over here. So, but it came in at a negative growth. So in fact, of more jobs, net jobs was lost at negative 5.4K. All right, so that actually causes the Aussie dollar to actually do a minor intraday decline right now as we are speaking. So but one thing consolidation was the unemployment rate remains steady at 4.2%. Okay, so that's actually moved in line with market expectation over here. All right, so that sum up the first segment of the daily dose. Now let me move on to the second segment, which is the intraday technical outlook very quickly. All right, so let me expand my screen first. Okay, so now let me start with the FX market. Okay, FX market. So let us now take a look at the euro dollar. Still recall that euro dollar yesterday we do have a bullish bias. So bullish bias hit our first resistance that zone, which is the 1890 slash 1.1910. So 1.1890, 1.1910. It hit, can't break through, and did that slight pullback during the onset of Fed chair press conference. And what we could see right now is now fast approaching my pivotal support zone again, which I highlighted yesterday. So level still remains the same. Remains the same, and also the RSI now is also coming very close to the oversold region. Okay, pretty much very close to the oversold region. So no point playing that minor pullback. So I will use this minor pullback to look out for a bullish reversal candlestick to maintain my bullish bias, since that is coming again very close to that pivotal support level. So in terms of risk reward perspective, I found it there's no beneficial to actually have that bearish outlook, because it's approaching very close to that short-term pivotal support level. So I'll rather use any potential slide to look out for bullish reversal candlestick and maintain that bullish bias above at that 1.1790, 1.1770 short-term pivotal support zone on the euro dollar. And for a intermediate resistance level for today, I have a slightly lower one at 11860, which is very important. So 11860, this was the rejection level that at upon the prior to the release of the FOMC, and also after the release of the FOMC statement, the dot plot, and as well. So that they form this rather sharp intraday movement, volatile move. So the top of the move, of the top of that candle, which is also slightly above the opening price of this hourly volatile candle, is at 11860. So a clearance above 11860 will increase the odds of the bulls coming back into the euro dollar again, retesting 11890, 11910. However, if price action starts to break down below 11770, then today's bullish bias will be negated to see a further slide to retest 11740 and potentially even 117 figure level. That means it's a much more deeper minor corrective rebound. So 11740 is very important. Why? Because that also confluence with the minor ascending channel support, and 117 figure constitute confluence with the rising 20-day moving average. So that's for the euro dollar. Next up will be the sterling dollar. So the sterling dollar also hit our first resistance level at 136.80, 137.15. Okay, it hit our resistance level. In fact, it hit two resistance level that came in with our expectation before that pullback took place. And right now, that pullback actually stopped right exactly at the the lower boundary of this minor ascending channel that I drew from the low of 3rd of September. Whoops, where's my line? Okay, here. It's not as right exactly here. So no change, given that it's now managed to actually stop at this lower boundary of this minor ascent channel, and also just right above our pivotal support that we highlighted yesterday, 135.90, 135.70. So I'll be still using 135.90, 135.70 as my pivotal support zone to maintain my bullish bias on the sterling dollar. First resistance level to watch will be at 136.80 over here, no change. So 136.80, above it, potentially see a retest of yesterday's intraday high, almost at 137.15, which is my resistance level that I have previously as well. Very close to it, because yesterday intraday high is at 1.3726 over here. So above 137.15 potentially may retest the 2nd of July 2025 minor swing high at 137.50, pardon me, at 137.50, which is also the one-time Fibo extension of this ongoing bullish impulsive upmove sequence on a very short-term minor uptrend phase that is still ongoing since the low of 3rd of September. Only a bearish breakdown below 135.70 will invalidate today's direct bullish bias view to see the continuation of this minor corrective decline extending further losses to revisit the 20-day moving average also converging with the minor swing low of 11th of September at 135 figure level. So that's for the sterling dollar. Up next will be the Aussie dollar. So like I mentioned, the Aussie dollar today, it actually did a slide over here. So this slide actually due to actually that weakness on the so-called employment job data change in Australia that I highlight to you guys that came in way below expectation. But what's interesting over here is that the hourly RSI has already hit the oversold level and now managed to bounce off from the oversold level. So what we could see is that yesterday it hit our first resistance zone at 66.80, 67 figure level before shipping that pullback, the current pullback over here. So right now I'll be using the first support level at 66.20 to then pivotal support will be at 65.95, a slightly adjusted one. So this 65.95 is right exactly the lower limit of this ongoing minor ascending channel that I drew from the low of 22nd of August. So I'll still be bullish on any dips over here. So maintain that potential bullish bias on any potential dips, still maintaining that minor uptrend phase that is still intact on the Aussie dollar. But resistance zone will still remains the same on the intraday basis with 66.80/67 figure level. So this level very important, especially 67 figure level. Why? Because 67 figure level is in fact the upper boundary of this expanding wedge range configuration since the low of April 2025 over here. And what's interesting over here is that if we start to see a bullish breakout above 67 figure level, then that could start to see this minor uptrend phase that has been on the intact, that has been going up since the low of 21st, 22nd of August, could start to transform into a much more medium-term / major-term uptrend phase on the Aussie dollar. So, but on an intraday basis, the first resistance level still remains the same over here. That means, i.e., if I were to be bullish, I will still be bullish up to until this level. Okay, until we have a clear breakout above 67. Then the next level to watch out for will be on the intraday time frame will be 67.70. Right, so that's from a 1 to 3 days of price action perspective. Only a bearish breakdown below 65.95 will invalidate today's bullish bias to see the extension of this minor corrective decline to test the rising 20-day moving average, confluencing at 65.70/65.55 next. Below it, potentially see a revisit of the 50-day moving average at 65.30 over here. So even though the price action breakdown below 65.95, it may not actually kickstart a medium-term downtrend phase because price action is still trading above the 20-day and the 50-day moving average that is still supporting this ongoing potential medium-term uptrend phase yet that yet to be confirmed because price action hasn't broken up above the 67 figure level. Okay, next up will be the dollar yen. So dollar yen continues to be very, very, very choppy. So what we could see is that yesterday dollar yen tests our first support level, which is the important medium-term ascending wedge range support that has been in place since the low of 22nd of April 2025. So it tests this level at 145.95 before bouncing back up during the onset of Fed Chair press conference at 145. So this 145.95 is indeed a critical support level of the dollar yen. So let's go to the dollar yen chart on a intraday basis on the hourly time frame. So hourly time frame yesterday, I also do keep a lookout for a bounce over here. So the bounce dictates shape. So now the bounce is actually stalling right exactly at our first resistance that I mentioned yesterday at the 147.05 level. Still watching that 147.50 level. So using 147.50 as my short-term pivotal resistance still remains unchanged. So that is a 20-day moving average. So as long as this 147.50 resistance didn't broke out on the upside, and also the RSI now is coming very close to the overbought level, potentially it could actually do another revisit down towards that range support area again, 146.30 followed by the 145.95. So this 145.95 very important. So we need to have a daily close below 145.95 that I could has a much more confident view that the 5-month plus of sideways range configuration, the dollar yen has managed to do a bearish breakdown from it, then that could lead to a potential multi-week decline on the dollar yen. So till now, it still continues to be trapped inside this ascending wedge range configuration. Unless we have a bullish breakout above 147.50, then today's bearish view back towards the lower limit of this ascending which range configuration will be invalidated to see a squeeze up towards the upper boundary of that ascending wedge range configuration. In first step will be at 147.95. A breakout above 147.95 will take us up towards the swing high area of 2nd of September and 3rd of September, and so confluence with the 200-day moving average at 14875/14895. All right, so that sum up the intraday technical outlook view on the four major US dollar pair. So let's move to the stock indices, starting with the Hong Kong 33, representing the Hang Seng Index. So the Hang Seng Index managed to stage that rally as expected, hit our resistance level 26,940, and also cleared above 26,740, which is my pullback resistance level right now. So at the yesterday US session, it managed to actually test 27,740 before bouncing back up. And given that it didn't have a proper clearance above 26,940, so this is still a first resistance level to watch. So still maintain that bullish bias view on the Hong Kong 33 right now, with a tightened pivotal support level at 26,530, which is the former minor swing high area of 12th of September and 16th of September, and so very closely related to this previously major ascending channel. Upper boundary from January 2024 low has been broken out yesterday, now turns into a pullback area support at roughly 27,530. So resistance level will be at 26,940. Above it, potentially seek out this zone over here, 27,125/27,285. And most importantly, there's a major key resistance at 27,500, which is also very close to the 1.618 Fibo extension taken from the low of 1st of August. And this 27,500 is a very important level. Why? Because if you go to the daily chart of the Hong Kong 33, represent Hang Seng Index, the 27,500 is in fact the long-term circular descending trend line that kept previous major up move since January 2018 high. So that is also prior to the COVID period. So if you go to the weekly time frame, so this is what I mean. Okay, if you go down, okay, this is the high over here, the current all-time high that kept previous rally pre-COVID. So if we could have a bullish breakout above 27,500 on a weekly basis, so this represents the start of a new major uptrend phase for the Hong Kong 33, which is very, very positive observation if that were to happen. So from a intraday perspective, we are now we're taking things one step at a time. So once it hit the 27,500 level, so it's time to be much more cautious over here, because there could be sign of a profit taking coming into play, given that 27,500 is a very key major resistance level. So for now, 26,530, that adjusted tighten pivotal support to maintain that bullish bias. Only a breakdown below 26,530 will invalidate today's bullish bias to see a further another round of minor corrective pullback sequence unfolding into the Hong Kong 33, exposing the next intermediate support level at 26,275 in first step, which is the minor congestion area of 10th of September and 15th of September. If this level can't hold, the pullback will unfold into a deeper kind of configuration to revisit 25,860, which is the former 4-week plus of range resistance previously, now turns into a critical pullback support that also confluence with the rising 20-day moving average over here. So that is the Hong Kong 33. Next up will be the Japan 225, representing the Nikkei 225. So the price index is going to push up as expected. So given that it hasn't broken above our first resistance level yet, I do not want to tighten my pivotal support to be so tight. So first support level to watch in any pullback will be this former minor swing high, tested on the 16th of September, tested on the 17th of September, and do a bullish breakout today. Okay, so this will be a pullback support level. That will be my first pullback support level. First support level to watch will be at the 45,000 figure level. So unless we have a clear break above 45,625, then I will tighten my pivotal support level to 45,000. So now pivotal support still remains the same at 44,560. Maintain that ongoing bullish bias recovery on the Japan 225, representing Nikkei 225, to seek out the next intermediate resistance at 45,960/46,220 over here, which is all confluence with the upper limit of this minor minor ascending channel that has been in place since 1st of August 2025. Only a bearish breakdown below 44,560 suddenly will invalidate today's bullish buyer's view on the Japan 225 to kickstart another minor corrective decline sequence, exposing the next near-term support level at 44,050 level. All right, so that's for the Japan 225. Next up will be the Germany 30 that represents the German DAX over here. So the German 30 continues to remain rather lackluster or weak against other major stock indices as it continues to trade below the 20 and the 50-day moving average. So from a longer term perspective, if you look at the 4-hour chart, it could be undergoing this rather complex sideways range configuration that has been in place since the fresh all-time high of 10th of July 2025 at 24,655. All right, so this could be a very complex sideways range configuration with the bottom of the range at 23,180, 23,025 over here. So with that, level still remains the same. That means the pivotal resistance level will be at 23,630. So as long as this pivotal resistance is not surpassed to the upside, I will still maintain that bearish bias view within that complex sideways range configuration that I highlighted to you guys over here. Lower limit of that sideways range configuration will be the support at 23,180. Below it, 23,025. We're also very close to the 0.764 Fibo extension taken from this ongoing minor downlick that has been in place since 15th of August. Only a bullish breakout above 23,630 will invalidate today's bearish bias view on the Germany 30 to see a squeeze up towards 23,900, which is also confluence with the 20-day moving average as well very closely, and as well as the range resistance of 5th of September and 10th of September, also at 23,900. So that's for the Germany 30. Next up will be the US Wall Street 30. So the US Wall Street 30 bounced exactly as expected. So like I mentioned yesterday, it was resting right exactly at our pivotal support, which is the former pullback. For the pullback of that former minor ascending triangle range resistance, and yesterday there was a bullish divergence that's being formed before shaping that strong rebound over here, clearing above the 46,060, 46,180 first resistance level, and also almost touch our next resistance level at 46,365, 46,400. So given that it hasn't cleared above 46,400 level, I do not want to tighten the pivotal support to be so tight. All right, so I will still be bullish in any potential pullback that may take shape today, given that the RSI has managed to exit from the overbought level yesterday. So there could be a minor pullback taking shape in today's European session to US session. So pullback support level to watch will be very clearly this former minor swing high tested. This very volatile candle didn't have a close below it. So this during the onset of that Fed chair press conference, and thereafter managed to bounce higher high. So this will be my first pullback support to watch, 45,960, 45,960 first pullback support. And unless we have a bullish breakout above 46,400 thereafter in the US session, then I will tighten my pivotal support level to 45,960. So for now, the pivotal support still remains the same at 45,780, 45,690. Maintain that bullish bias on the US Wall Street 30 as it's going to move higher towards the upper limit of this minor ascending channel that has been in place since 1st August 2025 low. So next resistance level to watch after 46,400 level will be at 46,570, followed by 46,750, which is a bunch of Fibo extension cluster levels. Only a bearish breakdown below 45,690 will invalidate today's bullish bias view to see another round of minor corrective decline sequence unfolding to retest the next near-term support level at 45,425, which is the minor swing low area of 9th of September and 10th of September. Next up will be the SPX. So recall that yesterday SPX, we do be cautious of that pullback. So that pullback exactly takes shape as expected. Hit our first support level and shape that minor bullish reversal that has taken shape over here. So now it's actually fast approaching that next resistance level at 6,660 over here. All right. This. So given that it's actually fast approaching this level, so what I want to do now is that given that yesterday there's this bullish reversal right exactly at 6,580, so I will use this level here as my adjusted pivotal support, 6,580, slightly upwards above 6,550 that we have yesterday. So let me change it. Okay, let me put it in better. Okay, let me put it down. Okay, oops, sorry. Okay, give me a couple of seconds. Let me rewrite again. So this will be 6,580. Okay, so this will be the adjusted pivotal support level for today for the SPX 500. So using 6,580 as my adjusted short-term pivotal support because of that bullish reversal that's being seen yesterday after that anticipated pullback that we have. Maintain that bullish bias view. Next resistance level 6,660. Above it exposes 6,680, 6,690, which is the Fibo extension cluster level. Only a bearish breakdown below 6,580 will negate today bullish bias view to see another round of minor corrective pullback unfolding, exposing the next near-term support level at 6,550 followed by 6,520. So if we float down towards this level, I'll be looking out for bullish reversal candlestick again to flip my bias back to the bullish stance, given the fact that it's still trading above the 20-day and the 50-day moving average. And the 6,520 level is coming very close to this upward sloping 20-day moving average as well. All right, so that's for the SPX 500. Maintain that bullish bias with an adjusted pivotal support at 6,580. Next up will be the Nasdaq 100 over here. So the Nasdaq 100 bounced as expected. Over here it bounced, hitting our pivotal support before shaping that V-shaped recovery over here. All right, so with that, given that it's now still at it actually come. Okay, so if I were to tighten my first pivotal support level, the pivotal support level to 24,140 is so very close to my previous pivotal support at 24,050. So I'll still maintain the same over here in any potential bounces that could take shape over here. So as long as any bounce maintain above this pivotal support of 24,050, the next resistance level to watch out for will be 24,530, 24,570, followed by 24,695, 24,770, which is a Fibo extension cluster level. And if I were to do a ascending channel projection taken from the low of 2nd of September. Okay, that is also the upper boundary as well. All right, so given that I don't want to, it's no point tightening it to 24,140, so it's very close to 24,050, so still maintain the same. Unless the price action suddenly do a bearish reversal and break down below 24,050, today's bullish bias view on the Nasdaq 100 will be invalidated to see another round of minor corrective decline sequence unfolding towards 23,930 and even 23,755. We also correspond to the rising 20-day moving average. All right, so that's for the major stock indices. Very quickly, let's go to the commodities market, starting with gold XAU/USD. So for gold XAU/USD, price action now has started to trade sideways over here. So yesterday, it actually managed to come down. It hit, then it managed to survive right exactly at my Titan pivotal support level, and also very close to the lower limit of this minor ascending channel that I drew from the low of 22nd of August. So the pivotal support still remains the same, unchanged at 3,644 over here. So I still maintain that bullish bias given that it hasn't broken below the pivotal support, but my bullish bias conviction now has been lowered now, given that it starts to trade like a sideways configuration, a minor sideways configuration. So I will have an upside trigger level today, which is very close to the volatile candlestick on the 2 a.m. mark, which is the onset of the Fed chair press conference. The starting part of this black candle, which is very close to the upper opening price candle, which is at 3,688 over here, and also confluence with a very small little hourly doji candlestick 2 hours before the release of the FOMC outcome. So this level 3,688 over here, 3,688 will be my upside trigger level. So if we could have an hourly close above 3,688, then my bullish conviction will increase for the gold XAU/USD for it to go up higher towards the next resistance level at 3,725, followed by 3,750, which is a Fibo extension cluster level that I mentioned previously. However, if price action unable to move up above 3,688, then potentially it could start to move in a very sideways range configuration again, lasting for about one days or so. However, but if price action starts to break down below 3,644, then the bullish bias view will be invalidated to kickstart a round of fresh minor corrective sequence, exposing the next near-term support area at 3,620 3,600, and below it may see 3,561 coming in next. We also confluence with the rising 20-day moving average as well. So if price action float down towards this 3,600, 3,560 zone, I'll be on the lookout for bullish reversal candlestick to flip my bias back to the bulls again, given that the medium term and major term trend on the gold still remains intact on the uptrend basis. Why? Because it's still trading above the 20 and the 50-day moving average. So that's for gold XAU/USD. Lastly will be the West Texas crude oil. We saw a rather choppy price action movement as well. So yesterday we have a neutrality stance between 65.30 and 64.10. So price action managed to go down below 64.10 and now also trading below the 20-day moving average. So it seems to us that it may now be floating down towards this complex sideways range configuration, a minor, that means it's a range within a range. So this could be a minor range configuration that has been taking shape since 5th of September over here. Tested one time, tested second time before bouncing up, but this bounce can't surpass above 65.30, which is my upper limit of that neutrality range I have. We also a confluence with the downward sloping 50-day moving average as well. So using this critical resistance level, which will be my pivotal resistance level for today, 65.30 pivotal resistance on the West Texas oil, flip to a bearish bias stance, but we in this minor range configuration that has been in place since 5th of September low. So next support level to watch will be 62.70. A breakdown below 62.70 may see a retest of this minor range support level at 61.85. Only a bullish breakout above 65.30 will invalidate today's bearish bias view to see a squeeze up towards 66 figure level, followed by 66.90, which confluence with the former major, the major descending resistance that has been in place since 28th of September 2023 high. All right, so that's sum up the intraday technical outlook of West Texas oil and the key broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So today there will be also another central bank meeting, which is Bank of England. So for Bank of England, market is expectation no interest rate cut to maintain at 4% over here. So what's interesting is will be the meeting minutes once it released. Will it be indication of what the ECB did, where officials has now starts to giving guidance that Bank of England is also coming very close to its interest rate cut cycle. So if that were to happen, that could actually solidify further dollar weakness going forward. So that will be at 7 p.m. Singapore time. Yes, 7 p.m. Singapore time. Bank of England interest rate decision. So going forward in the US session, we have one more key economic data to look out for is the Conference Board Leading Economic Index. So this is considered as a leading economic indicator. So Conference Board comprises various metrics to form their leading economic index, taking into account of the health of the US economy from retail spending and looking at metrics from financial markets metrics as well. So for consensus view, they expect the leading index to actually point down lower to negative 0.2 from negative 0.1 previously in the month of September. So if this amount of money continues to inch downwards lower, that could actually continues to solidify the interest rate cuts going forward in 2025. By quickly taking a look at the CME Fed Watch 2. So for the CME Fed Watch 2, very quickly, right, just now I didn't share you guys. For the next meeting on the 28th of October, market is still looking for a very high chance of a 25 basis point cut. So that is in line with what the market has already been, the Fed has guided the market yesterday. 88% chance that the Fed will do 25 basis point cut on the next meeting on 29th of October. So if you look at the aggregated one basis, market is now looking at a high chance of 80% chance more than before the FOMC meeting. Before the FOMC meeting was about 70%. So now it went to 80% chance that the Fed would do another cut on the last meeting of the year, 10th of December, to bring it down to 3.5%. So far after that, the cuts has been at 3 cuts next year. So that's much more dovish than what the Federal Reserve penciled in the latest dot plot. So in the latest dot plot, they only implied one interest rate cut of 25 basis points for 2026, but market is looking for 3 interest rate cut. The next cut to come in the 18th of March meeting, 89% chance to bring it down to 3.25%, then 80% chance to bring it down to 3% to 3.25%, means the second cut potentially on 2026 on the 17th of December, then thereafter to be on hold and followed by potentially either on the October meeting, which is 56%, and 67% chance on the 9th of December 2026 meeting to bring it down to 2.7% to 3%. So market is now implying 3 interest rate cut for 2026. So if the so-called the leading economic index as compiled by leading economic index as compiled by the conference board continues to inch down lower and it goes down way below what market is expecting, let's say it's at negative 0.3 to negative 0.5%, then potentially we may see more dovish bets increase for next year 2026 US federal interest rate cut cycle as being portrayed by the CME Fed Watch 2 I showed earlier. So if that's were to take place, that could potentially also reinforce further dollar weakness as well. Right, so that will be at 10 p.m. Singapore time. Then followed by that, we will have a quiet US session. So for tomorrow, one important data to take note of before the start of daily dose in Japan will be the core inflation rate at 7:30 a.m. Singapore time. So market will be looking at the core inflation rate and the core inflation rate, which exclude both food and energy. So for Japan, it's a bit weird. They have the core inflation rate, which only include X energy, whereas if you exclude the food and energy, they call it core interest rate. So the core interest rate will be much more interest because the Bank of Japan is watching the core inflation rate. So they don't have a consensus forecast here, but for trading economic view, trading economics forecast is at 3.2% year on year, slightly below 3.4% that was printed in the previous month of September. And after that, we have the Bank of Japan interest rate decision. So market is expecting no change at 0.5%, given the fact that right now there is a potential political leadership vacuum right now because of the resignation of the current Japanese Prime Minister. But however, market participants will be looking out for the statement. Are they still guiding market for at least one interest rate hike before 2025 ends? Not cut, it's a hike. So Bank of Japan is still on the path of gently introducing normalization monetary policy to actually further gradually increase their short-term interest rate. So that is at 11 a.m. Singapore time. All right, so that's sum up today's daily dose of market insights. A bit long today. Why? Because of the very interesting movement that has taken shape yesterday, ex-post FOMC outcome, the release of the dot plot, and also the Fed Chair press conference. All right, so with that, I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.